question 34. In this question asks for how much will each of the company's liabilities be paid at liquidation, and it's obvious that the company does not have enough assets to cover all the liabilities, which means that for those partially secured or unsecured creditors, they will only get a portion of their receivables back. Okay, so let's go ahead and look at the statement of affairs directly. And so normally we will start with the assets, and under asset first is going to be the asset that's pledged with partially secured creditors. And based on the information, we know that the land and a note payable A of 90,000 was secured by a land, have a book value of 50,000 and fair value of 70,000. So we are going to use the fair value of the land as the amount that can be used to cover liability. So those are the pledged with partially secured creditors. So for land, its fair value of 70,000. However, the notes payable A have 90,000 in total, which means that nothing is available for unsecured creditors. Second one is the building. The building is secure. There's a note payable B, 120,000 is secured by a building. Its current fair value is 40,000, still not enough, so which means that nothing left for unsecured creditors. And then let's have a look at those free assets, or those assets not pledged with any creditors. This company have cash, inventory, equipment, and in total that's 120,000. And for all of them, we are going to use for the cash, inventory, and equipment, we always use their net reliable value, not their book value. Okay, and next is that we are going to use the total available to pay liabilities for unsecured creditors, and then less those amount need to pay for the liability with priority. Well, in order to get those liability with priority, we need to go ahead and prepare the liabilities and the stockholders' equity part. Okay, in this part, we will start with first the liabilities with priority. Those are the creditors that will get payment first, including those administrative expense and income tax payables, because those are the things that have the priority. In total, that is 50,000, and then this 50,000 is what we need here. Alright, so when the company paid those liabilities with priority, the available, then the remaining amount available for unsecured creditors is 70,000. So next we need to see how much they owe to those unsecured creditors. So let's move on. And first, look at those partially secured creditors. So there we have a note payable A. The total amount is 90,000. Is secured by a land of 70,000, which means that 20,000 are unsecured. For note payable B, it can be paid with the building, but still have 80,000 unsecured amount. And then for those unsecured creditors, we have accounts payable. That would be the just accounts payable to the suppliers, and then there's a note payable C. And for the accounts payable, that's 120,000, and for notes payable is 6,000. And in total, the total unsecured non-priority liability is 280,000, and this is the amount we need over here. So in total, they have 280,000 owed to those unsecured non-priority liabilities, but they only have 70,000 available, which means that there is a 210,000 deficiency. Okay, so this part is important. We are going to use the numbers here to calculate what's going to be the percentage of liability they can pay back. We use the total available fund here, 70,000 divided by the total amount they owe to those unsecured and non-priority liabilities will get 25%, which means that for those unsecured and non-priority liabilities, the company can pay 25% of them to 25% to each of them. For example, for notes payable A, it can get 70,000 first, and then it will get 25% of this 20,000 unsecured one, which means that it will times 25% plus. That's going to be the total amount the creditor of notes payable A can get back. For creditor of notes payable B, it can get back 40,000 and then plus 25% of this unsecured amount. And for account payables and notes payable C, they all can only get 25% back. Okay.